Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Today, we're reviewing 2023 and looking ahead to 2024. To start, there were a small number of big winners this year. This chart looks at how much specific stocks or sectors outperformed the overall stock market in 2023. Basically, if you own tech businesses and 2 pharmaceutical stocks that sell new weight loss drugs, you had a phenomenal year. While the share price performance of the big winners ran far ahead of their fundamentals, the big winners were also the only ones growing their earnings in a major way. We did not buy tech stocks for much of this year because the share prices of these companies ran far ahead of our fair value estimates for the businesses, but we do want to point out why tech stocks are worth owning on pullbacks. The profit margins in the tech industry have expanded over the past 20 years and are now much greater than other sectors. Buying shares in businesses with high profit margins is a great choice when the valuation is right. We expect another opportunity to add tech into the portfolio within a year or two, but for such a volatile sector, it's important to wait for the shares to be undervalued again. Tech stocks make up a significant portion of the largest companies in this stock market, and those types of companies may struggle to outperform for a while. This chart measures what percentage of the total market cap of the stock market is represented by the 10% of companies that are the largest. Over the past 100 years, the top 10% have made up anywhere from 50 to 75% of the total value of the market. Today, we are back near the peak seen at the end of the dot-com bubble and in 2020. This is why we believe stock selection will be key for the rest of the decade. Blindly owning the largest stocks is unlikely to generate outperformance over the next few years. Current valuation does not foreshadow what's going to happen with your stocks in the short term. Anything can happen in a given year. But the starting point that you buy in at does have a major effect on your 5 and 10-year returns. The price to earnings ratio of the S&P 500 using 2024 estimates is above 19 times. This is nearly 10% above the average valuation of the past 10 years and almost 20% above the average of the last 20 years. The valuation multiple does not have to return to average right away, but we know at some point that it will. This creates a 10 to 20% headwind to returns that must be offset by earnings growth. The problem is we believe analyst estimates for earnings growth next year are too high. The Federal Reserve projects 3.8% nominal GDP growth in 2024. Historically, nominal GDP growth is a good indicator of revenue growth. So if their forecast is accurate, we can expect companies to grow revenue about 4% next year. But analysts believe earnings per share will grow 11% next year. That gap between 4% and 11% has to be made up by profit margin expansion and share buybacks. Profit margins are already near peak levels. We think it will be difficult for companies to efficiently grow in the manner that analysts hope. Another reason it will be tough for companies to grow at a double-digit rate is because the economy continues to slow down. The monthly ISM manufacturing survey evaluates the percentage of industries that are reporting growth in the United States. For the past year, only about 20% of industries have been growing. Employment growth for manufacturers has been negative for nearly a year, too. It will be hard for the economy to accelerate without key cyclical areas like this returning to growth. One trend that investors are excited to see is inflation falling from a peak of 9% in the summer of 2022 to 3% today. But we think it's going to be difficult for inflation to get down to that 2% target that the Federal Reserve has before it would say that inflation has been defeated. This chart looks at which components are driving inflation. In 2022, it was energy, food, and costs rising in other goods. Inflation from those sources is now gone. What's left is rising prices in the services sector, and this could linger for a longer time. Most of the services inflation comes from rising residential costs. The Federal Reserve uses a calculation for this that's a bit different from market pricing data you might see in real time. This chart shows how much housing costs have increased in the past 3 years. The green line uses market pricing from Zillow that's more accurate with real time, and the orange and blue lines are the calculations that the Fed uses. The green Zillow line has finally started to flatten out, so some investors are saying shelter inflation will follow suit very soon and services inflation will disappear in a matter of months. The problem is the orange and blue lines still need to catch up to the green line. Therefore, the Federal Reserve's measure of shelter inflation could continue to rise through 2024, And if it keeps rising, we're unlikely to reach the 2% inflation target in the short term. If we don't reach 2% inflation, we do not think the Fed will want to cut rates as soon as investors would like. We continue to follow employment data closely, and what we see is what was a very tight jobs market is beginning to quickly return to normal. This chart shows total job openings divided by the total number of unemployed individuals in the United States. The number has drifted up over decades because it's easier to post a job opening today online than it was pre-internet. We've been watching for when this ratio returns to the level in 2018 and 2019. It's nearly there, and then we anticipate it moves even lower as the economy weakens. There's another factor for consumers that has been different during this cycle, and that's the rapidly declining amount of excess savings. This chart shows the growth in excess savings for households after the start of each recession since 1970. Typically, excess savings rise in a steady manner for 4 years after a recession starts. However, after the pandemic recession in 2020, fiscal stimulus to households created a spike in excess savings that lasted a little more than a year. Now that savings is declining in a manner we haven't seen in the past 50 years. 80% of the excess savings are gone, and we would expect the rest to disappear in about 3 months. Our final slide highlights a small part of our process that we think is an important reminder to investors. This chart looks at 30 years of the S&P 500 and splits the performance between how the index performs when it was down the previous day versus when it was up the previous day. We are long-term investors, but we look for every edge possible to generate satisfactory returns. We've been aware of this factor for years, and it's why we only want to buy new positions in clients' accounts when the stock is trading down by 1% or more on that day. These small advantages can add up to a lot over decades. In summary, despite the major stock indices trading near record highs, when we look at company valuations, we think a lot of optimism is already priced in. When we analyze the economy, we think it's still in a decelerating trend that could lead to recession. As a result, we want to opportunistically add in defensive sectors, but the real goal right now remains capital preservation while we wait for more fear in the market. If you have any questions about this, please contact us. We like to provide the information we think is most valuable for investors. If you'd like to see more videos like this, please subscribe to our YouTube channel.